Hey, this is Michael Sayer, your 401k advisor here at CUI Wealth Management, your retirement plan partner. Today I want to talk a little bit about asset classes, and this is really important when it comes to investing because sometimes we have this ambiguous idea that we're all in or all out in the stock market or the markets in general. When you turn on the news, you'll see different charts that show the S&P 500 or the Dow or the NASDAQ, and that'll give you an idea of how those specific markets are doing. But in order to really understand what's appropriate for you to be investing in, it's important to understand the different types of asset classes there are. There are three basic main types of asset classes that you're going to see when you're investing. Those are cash or cash alternative, stock or equity, or bonds/fixed income. And the type or allocation of these types of investments is going to really impact what to expect when it comes to investing. We're not going to get into the nitty-gritty because you can divide those and subdivide those into other categories, but today let's talk about high level what those look like. Let's start with cash. So cash, we're familiar with cash because we bank in cash. We use cash for our day-to-day purchases. Inside a portfolio, it's very similar. So you're going to see money markets classified as cash. You're going to see cash alternatives. You're going to see a stable value fund in a 401k. And the main components of that is you're looking at reducing risk and giving up the potential for higher returns when you're putting in cash. The second is stocks or equities. Stocks and equities are on the other side of the spectrum in terms of risk. There's higher risk, but also higher potential for return. And this is because when you're investing in stocks or equities, you're actually purchasing shares of a company. Now, in a 401k, you're generally not going to be purchasing individual stocks. You're usually going to have all of those lumped into a fund, but equities are ownership in companies. And as you know, there's different types of companies, and those have different risks. There's different sizes of companies, and those come with different risks as well. So we have cash on one side. We have stocks or equities on the other side. So those are two of the three basic assets. The third is bonds or fixed income. Now, the word fixed income comes from the idea that you invest in fixed income and you generally have fixed income payments from that. And that's because fixed income is loans. So bonds are loans. You loan out your money to a government, to a corporation, and just like any other loan, there are different credit ratings, and so those who have a better credit rating may pay a lower interest rate, but they also generally have less volatility. And those with lower credit interest rates are generally going to pay a little bit higher because of the credit risk, but there can be a little bit more volatility there. So those are your basic high-level three types of assets. You've got cash, you've got bonds or fixed income, you've got stock or equities. And usually in a portfolio, you're going to have a fund that either has a specific goal for that type of fund, or you're going to have a mix of those different types of asset classes to fit your needs based on your risk tolerance, your time horizons, and so on and so forth. So I hope this has been helpful. We'll do more of these in the future. Once again, more information is below. You can reach out to us if you have any questions. Once again, Michael Sayer with CUI Wealth Management, your retirement plan partner. Thanks.